Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We hear often, a lot of people tell us, I've been listening to you for a year or two or three, and then at some point they're ready to reach out. That's fantastic as well. And if you're catching the podcast, we love that as well. So we do podcast every episode. So anything investment related, any questions that you have on anything we talk about on the radio, please always feel free to reach out. 630-492-1912, 630-492-1912. As you know, the purpose of the show is education. Everything we do is to educate. Most of the individuals on the radio are selling something. Generally, it comes down to something in the annuity space, and they really just package themselves up as financial planners, but yet they already know that it's an annuity that they're going to sell. So I think objectivity and authenticity in the on the radio kind of financial talk show space is just not there, and it's something that we've really strived to bring to the market, and clearly based upon the response that we get, the people that reach out, we feel like we are doing our job, and we're going to continue to do our job, which is to educate you. I think the job of an advisor is to always make sure that you have something inside of your portfolio that can do well when the markets don't do well. We're not tax professionals. We're not legal professionals. Anything when we reference performance, as you know, past performance is not indicative of future results. When we talk about banknotes, when we talk about Bison Alpha, when we talk about Bison 2 and tax strategies, it's really for informational purposes only. So if it piques your interest and you want to know if it makes sense for you, we can certainly dive into what each of those strategies are. So 630-492-1912. Financial planning, as you know, financial planning is the heart of everything that we do. I think what differentiates us is we're going to run your RMDs out to age 95. May not sound like a lot, may not sound like a big deal. Probably have been told that your make too much money, have too much money for Roth conversions. We specialize in Roth conversions. If you have a 7-figure IRA, you will be surprised what those RMDs could amount to when we really roll and look at those, roll those potential RMD amounts year over year. It can get to be pretty staggering. So those are the things that we do. As you know, we're big proponents of the banknotes. Banknotes is a catch-all phrase for structured banknotes. Each bank calls them something different. They are a prospectus item, so if you have any interest, just call and reach out. And best practice is just get a prospectus of the last note that we did. Watch the videos that we have, the educational videos, because education and articulating strategies, the pros and the cons, are really what our job is. We've come across so much here recently of people just having to sell the sizzle and not really dive deep into what the strategies are. So we'll talk a little bit about that here, today. But the banknotes are still, north of 12%. That's great. I mean, that's can't tell you if we're in a sideways to low growth environment for an extended period of time. Those banknotes that are backed by the JP Morgan, Citigroup, Bank of America's, BMO's, Morgan Stanley, UBS's, Bank of Canada's, BNP Paribas. I mean, there's just the largest, most financially well-capitalized banks in the world. As you know, the notes that we do, generally we're going to use strategies that have a 30% downside buffer. Well, it's called a barrier. So as long as those indexes the notes track do not drop more than 30% each month that they look at it. Now that's from issue, but each month they look at it. So as long as they're not down 30%, you're paid your monthly coupon payment. So if it's 12%, well, you get 1% a month. So it is very, very hard to compete with anything in the lifetime income annuity space when you compare what the bank notes are and what they're not. So saw an article this week that Morningstar put out, and they say the safe withdrawal rate is 3.9%. You work your entire career, your entire life to then just go and take out 3.9%. I have an issue with that. I think the data is the data, okay, but I think it's flawed data. I think it's flawed data in that they're utilizing really two asset classes or two asset allocation strategies. Generally, it's something of a mix of equities and bonds, and there's just many, many other ways to derive income. And when you look at what the banknotes are, I mean, obviously it's, you know, and the crazy thing is they're not new. More of a family office, more of an institutional, more of a European type strategy. And I'm amazed that more advisors have no idea what the banknote strategies are. They may make you think they have an idea, but if they're talking to, you know, individuals like us, we can tell real quickly that they just have no clue. But you think of 3.9% in an asset allocated model, or do you want to get double digit distributions through the banknotes and go through all the risks, the rewards? To me, it obviously, you know, we would much rather include the banknotes, especially when you look at where bonds are today and you look at the historical performance of bonds over the last 5 years. I mean, I still believe we're in the worst drawdown in history of the bond market. You know, pick AGG and look at what it's done over 10 years. We're not picking on AGG or any bond fund, and the returns are just have not been, in my opinion, meaningful in any way, shape, or form. And so times change, markets change, and advisors need to change with it. And advisors have to educate. So, you know, the banknotes are still doing great. Tax reduction, you know, we talk an awful lot about tax reduction. So tax reduction is a kind of a cornerstone of what it is that we do as financial planners. Now, we're not tax professionals, of course. I have to tell you that. And anytime you're going to make an investment decision based solely on taxes, A, I think that's wrong. But B, it's always best practice to talk with your tax professional just to, you know, to get their opinion. But when you look at Bison 2 and our energy strategy, I'm really pleased that so many individuals from the radio show are now reaching out to learn more about Bison 2. And it's an energy fund. It's investing alongside of the majors in the Exxon, Chevrons, Conocos, Matadors, Vaqueros of the world. So I would call them majors and mid-majors in the best oil field in the world. And not speculating. It's just a fund that has significant diversification as an owner in many projects. And so the benefits are many. Non-correlation to the stock and bond market is obviously one of them. We don't often talk a lot about that, but when the markets zag, when the market zig, these tend to zag. That's just correlation. And you can look at historical correlations of energy versus the S&P. And it's, I think if we're in a low to sideways market, which I think is kind of the consensus. I mean, when you look at where priced earnings are today, historically speaking, the 10-year number at today's valuations has been annualized between -2% and 2%. That's just what the numbers are. And it's not me. It's just the numbers, right? So I guess it could be different this time. But if the markets do go down and you look at all the geopolitical risks that we're facing, you want to have a lot of outs in your portfolio. And what I mean by outs is strategies that can protect, strategies that like the banknotes that can still deliver distributions as long as the indexes aren't down 30%. Strategies like Bison 2, which is the energy strategy that can still produce cash flow irregardless of what's going on in the S&P 500 or the bond market. Now, that doesn't mean there's not risk, of course. I mean, there's risk in any investment, and those are the things that we go over once we have, conversations. But the tax benefits, again, are very, very meaningful. So we have so many individuals that have concentrated stock positions, meaningful concentrated stock positions, and congratulations. But they don't want to make changes because of those tax liabilities that will come along with that. Or individuals that would love to do a Roth IRA, but they've been told they make too much money, or they've been told that their IRAs are too big. Well, what about setting up a 3, 5, 7, or 10-year Roth conversion strategy and utilizing Bison Alpha or Bison 2, the energy fund, that we target $80,000 to $90,000 per $100,000 invested of tax benefits, and that's against active or passive income. Just go on your favorite AI and put in there, explain to me the tax benefits of oil and gas investing. Now, again, we don't invest only for tax benefits. I see it far too often, but the tax benefits are meaningful. So if you sold a business, you sold a building, sold a property, you're, a high wage earner that makes significant income, 3, 5, 7, million, 100,000, multiple millions a year, and you're looking to defer some of those taxes, we have to really have a conversation, and we have to go over, the pros and the cons, and we have to go over, what it is and what it's not. And, generally, we try not to, we think the tax benefits just come along with the investment. We don't like people investing simply because of the tax benefits. We are much more concerned about the return on invested capital and the return on the investment. So it's a 5-year target strategy. So, it could make up 10% of your money, could make up 20% of your money, could make up 5% of your money, could make up nothing. But there are very few advisors that are actively talking about meaningful tax reduction, not tax deferral, tax reduction. And again, we're not tax professionals. Anything we say is for educational purposes only. Always best practice to reach out to a tax professional. We certainly can get on those calls with you and your tax professional. We do that frequently. So 630-492-1912, 630-492-1912. Give us a call. Let's have a conversation. And if we can help you, then we're going to walk down that path of the financial plan, and then really just seeing if our philosophies align. So more after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We are located in Oak Brook, right across from the mall. We are, if you know where the Fidelity office is, we are in that building. We are on the 5th floor, so Suite 530. We'd love to have you stop in. No appointment needed. We do spend the bulk of our day in meetings or Zooms or conference calls with clients and potential clients. But if you would like to come in, no meeting necessary, just drop in. And if you're willing to wait a little bit until we are done with those meetings, we will certainly have some time for you. We really try to make sure that we are making ourselves available to everybody. So markets are what the markets are. I mean, it's kind of insane if you think about it. It feels like we're in a correction, but 60% of the S&P 500 stocks are beating the index. And that actually is one of the biggest rotations that we have seen lately. People are, I don't want to say dumping, but people are certainly lessening their exposure to risk assets. And they don't want to be underallocated to strategies. I mean, consumer staples right now. I mean, there just is some names that haven't moved that are really starting to move. And again, I think that's just portfolio management, right? Unfortunately, the bulk of advisors, they don't do anything. They just set it and forget it. And so I think that's the job of an advisor, is to be able to deliver tax reduction, to be able to deliver strategies like the bank notes, which are currently paying, still double digits, almost 12.5% with 30% downside protection. So as long as those indexes are not down more than 30% on that monthly valuation from the date you purchased it, you still get paid your coupon payment. So if it's a 12% note backed by JP Morgan, as long as those indexes are not down 30%, you still get your monthly payment. If they are down more than 30%, then you don't get paid that month. Doesn't happen often. It certainly could happen, but again, that's a very basic strategy that we are able to bring to the table. Again, it's a prospectus item, so there is no harm in reading a prospectus of a previous note. And so if you would like to do that, and if you'd like to take a look at that and read a fact sheet, read the prospectus, take a look at the videos that we have, certainly just give us a call and we'll make those available to you, 630-492-1912, 630-492-1912. But again, the indexes are near an all-time high, but many of the tech stocks, they're really starting to trade at much, much lower valuations. And it's anybody's guess what's going to happen. I found it very interesting that JP Morgan CEO Jamie Dimon this week, I wasn't in the meeting, so I'm going simply based on what it was reported. So I guess it could certainly be different. But it is being reported that he is starting to see parallels to the era before the 2008 financial crisis. That was from Bloomberg. And unfortunately, we did see this in 05, 06, and 07, almost the same thing. The rising tide was lifting all boats. Everybody was making a ton of money, is what he is reportedly to have said. Again, I wasn't in the meeting, but you don't have to be a conspiracy theorist. You don't have to go through too many mental gymnastics on the mathematical front to see that the market valuation is relatively stretched. And if you look at where historically those valuations, when they're currently this high, when you look at the 10-year annualized number, so the forward 10-year number, generally it's averaged between -2 and 2%. So you have to make sure today that you buy and hold strategies, 60-40, 70-30, just some sort of an asset allocated model. It's my belief, and I believe it to my core, that it is, I would just strongly advise against investing only in that strategy. And if you do want to invest in that strategy, which again, it's your money, you can do whatever the heck you want with it. Don't owe me anything. You don't owe other advisors anything. It's your money. It's your hard-earned money, and you can invest it as you darn well please. But if you are going to invest it in just an asset allocated model, please, please, please don't invest it through an advisor that is charging you an annual fee. You can go to Fidelity, you can go to Schwab, you can do it at Vanguard, great firms. And if that's your philosophy of just buy and hold, set it and forget it, just get rid of the advisory fee. So now, again, I probably wouldn't do that. I wouldn't recommend that. But if that is what you want to do, save yourself that 1% to 2% management fee, because that's going to add up over time. So 630-492-1912, 630-492-1912. We're really on an educational kick this year, and it's something that I, as the leader of Kuhn Capital Partners, have really started to stress, because our job isn't to tell you to invest a certain way. Our job is to look at your portfolio and give you an allocation on how we would do it if we were in your situation, how we would recommend our family, our moms, our dads to invest if we were in your situation. And I just see far too many advisors, far too many advisors where you're just a number, and it's just a static, asset allocated model that's marketed as something very proprietary. There's no tax reduction strategies in place. And when we look at like Bison 2, I mean, think about that in the energy space. Number one oil field in the United States, top oil field in the world, literally in a fund. Our fund invests as an owner in a minority owner in the projects of the majors. And we have every single list. You can see it. And you get massive tax benefits, anywhere from $80,000 to $90,000 per $100,000 invested. That's against active or passive income, 1099, capital gains, W-2, etc. Now, it's a target, right? It could be a little less, could be a little more. And we target a 5-year exit. So we acquire these portfolios, we acquire these assets, and then generally what we'll do is sell them to a fund who has a longer time horizon and wants that cash flow. We want to make our money and package it and sell it within 5 years. It could be certainly 2 years, could be 3 years, could be 4 years. But again, we target 5. I personally believe it's going to be much sooner than 5. But we're on our second fund and getting ready to launch our third fund here soon. But it's has all the checks and balances that you would need. So it's custodied at Charles Schwab. Now that Charles Schwab doesn't say it's good or bad, but we did go through the due diligence to get on their custodial platform, third-party administrator, so they handle all of the money, third-party transfer agent, third-party accounting, third-party audits on an annual basis. So it really does check all of the boxes. And what we found here, especially here in the Midwest, is that it's pure education. And so we really want to win. And to win, we have to educate, because once you have an understanding, it's a very basic strategy, very, very basic strategy. We're just buying 1 to 3 to 5% interest generally in the projects of Conoco, Exxon, Chevron, Matador, Mewbourne, Vaquero, et cetera. Names that you have heard of, or names that if you haven't heard of them, they're readily accessible to see that they're a major to mid-major in the best oil field in the world. So it's a tangible asset. It's an asset that has no debt. It's an asset that, it does cash flow, and it cash flows regardless of what's going on in the S&P. And it does pay, it does have significant tax benefits. So 630-492-1912, if we can help you out there. And then also on the hedge fund side, so Bison Alpha, performance has been great. Now, again, I want to caution that you never invest, based on, historical performance. I think it's just a gauge, right? And it has such a short-term track record. We just launched it fourth quarter of last year, but it just gives us maximum flexibility. It's an event-driven hedge fund that can take advantage of near-term anomalies, near-term inflections in the market. And we don't have to stay fully invested. We can put hedges in place that can pay off if the markets go down. We can put option strategies built around the portfolio that if they expire worthless, it doesn't really hurt the performance on the downside. But if the names do what we think they're going to do or why we purchased them, it can really add significant gains, significant performance to the portfolio. So again, it's just flexibility. And so when you look at what it is that we're bringing to the table, now it's our fund. Okay, so it is our fund. And just like Bison 2, it is our fund. Some people, think that's a conflict of interest, and they're right. It is a conflict of interest because it's ours, right? But, we obviously have a fiduciary duty that we have to, live up to. And I look at it as we better have high conviction in the strategies. We can control the risk. We can control as much as you control, and we're not having to farm out things that are outside of our control. And so I personally believe it's a benefit, but, some people, may want to start with, some money in it. And when we look at, how people use us, how people come to us at Kuhn Capital Partners, we have the bulk of people we manage, I would say 100% of their money. But there are a fair amount of clients that say, I have a core strategy and we want to use you as a satellite manager. And so we're going to use the energy fund. We're going to use the hedge fund. We're going to use the bank notes, but we're going to keep, kind of our core strategy. And we're perfectly fine with that. Again, it's not our agenda, it's your agenda. And so however we can help in that, we want to make sure that we are doing that. So 630-492-1912, 630-492-1912. Make sure you reach out to us this week. Love meeting with new potential clients. We just enjoy it. Even if you don't become a client, it's an opportunity for us to always learn more about individuals and for you to learn and educate yourself. So 630-492-1912. More after the break. Listening to Destination Retirement. If you're catching it live, if you're a normal listener, active listener, we love it. Thank you very much. We love education, and we think we're the best educators. If we're not the best, we're striving to be the best, and that's what we're going to keep doing. So 630-492-1912, 630-492-1912. Banknotes, as we talk about every segment, still pricing around 12%. I think the last one was 12 to 12.5. I can't remember the exact number. But again, for those that don't know what the banknotes are, they're strategies that are issued by the largest banks, the JP Morgan, Citigroups, Bank of America's, Morgan Stanley's, UBS's. It's kind of an equity / bond kind of type of an investment. But when you see the videos, when you see the prospectus, when you see the fact sheets, I think it becomes very, very clear, because I believe it's very simple. When that note prices, it locks in index values, and it could be the S&P, it could be the Russell, it could be the Dow, it could be one note. Another note that we do is Russell, the S&P 500, and the KRE, which is the regional bank index, and that is a great note. That I think that one was around the 12.5%. But the date the note trades, it's really simple. For the life of the note, that is your reference point, and every month after you bought it, as long as none of those indexes are down 30%, you get your monthly coupon. So let's say it's a 12% note annualized, and that would break down to 1% a month. So on that monthly valuation, as long as those indexes are not down 30%, now it just takes one to be down 30%. Highly unlikely, but again, you have to know. But if one is down 30%, then you miss your payment for that month. And the next month has nothing to do with the previous month. And so really great strategy for cash flow. It just allows for a couple things. Cash flow, if we're doing double-digit cash flow with 30% protection, that's less that we have to allocate to get you the cash that you want. Maybe that's more growth. Maybe we can allocate more to growth. Maybe we can allocate more towards tax reduction with Bison 2, or we can allocate towards the hedge fund strategy like we've talked an awful lot about. But it's a very good strategy. And when you compare that head-to-head, with the lifetime income annuities that the bulk of radio shows are selling. They may not come out and say it, but that is what they're selling. It's going to be hard to compete. Now, that doesn't pay, those banknotes don't pay a 7, 8, 9, 10, 11, 12% commission. The radio is full of individuals that are trying to sell and convince people with that guaranteed lifetime income phrase, and it's very comforting, no doubt. However, you look at what the insurance companies are doing. The insurance companies, unfortunately, are allowed to show historical performance on illustrations, and that historical performance for the bulk of the indexes are back-tested, meaning it wasn't actually happening. It was just computer simulated, and there's such a difference between what they say they're going to do and what they really did. And that is shocking to me that advisors won't show that to clients. And so you have to really know what you're looking at. But unfortunately, unless you do this every day, you just don't know. So utilize us, 630-492-1912, 630-492-1912. A lot of people say we're anti-annuity. Nope, we're not. Lifetime income annuities, you just have to understand that the insurance companies put a governor on how much you can withdraw, and they give you just enough growth so you don't take that account to zero, because if you never take that account to zero, all you did is dollar cost average your own money out of that account. And I think actuarially, my belief is they know most accounts don't go to zero. So you are paying a whole heck of a lot for that guarantee word. So we strongly suggest that you can compare, the banknotes that is, in my opinion, significantly greater cash flow to that, especially when you're being told to wait 3, 5, 7, and 10 years for that income. We can really put a great case on why that just doesn't make a whole lot of sense if we're looking at, raw numbers. And a lot of people own them. A lot of people have bought them, and a lot of people have reached out to us. And it's funny. It's really from the same 3 or 4 people that are on the radio. And we see the same 3 or 4 names over and over and over again. And that's something that is unfortunate, because I think the objectivity of these advisors should come into question. So with that being said, that doesn't mean we don't like annuities, because our 5-year annuity that we use is simply tied to the S&P. It's very simplistic. If the S&P is down at all, your return is zero. So it's 5-year investment. Each year, contract year. So whenever you do it, they look at it 12 months from today. As long as the indexes, if they are down, your return's zero. And you get the first 10, currently at least 10.5%. Now that can change, of course, but currently 10.5% of the S&P 500. Now it doesn't include dividends, but that's a phenomenal strategy for some people. Some people would take that all day. Problem is, bigger RIAs don't show you that because they don't want the commission. I don't want the commission. I would much rather have an annual fee, because that's done as our insurance agent hat. That's not done in the our advisory practice. It's done outside of that. So yes, I would much rather have the annual fee, but it does pay a commission. But how we're paid, I don't personally believe should determine how we or what we recommend. But the larger the RIA, very few people are ever going to hear about that 5-year annuity. And you know what? A ton of people out there, I guarantee you, that would take the first 10.5% of the S&P, not including dividends, knowing that your worst year is zero. And anytime you get a gain, that gain's locked in. So we'll talk a little bit more about that here in a minute. But you look at the markets and you look at kind of the concerns that we have. There are many, so I want to address a couple of those right now. So first is valuation. Valuation. Are we at the top of the market? I have no idea. Nobody knows, but it's a concern. It's a concern of ours. You look at the concentration of names that have driven the market higher, and kind of the role reversal of what's happening, currently in those names. Many of those names have lost significant amounts of value here recently. So valuation, Howard Marks, Oakmark, Google them, phenomenal. You can read the same reports that I read. Had a great report out a handful of weeks ago that stated at current valuations, the forward 10-year number. So when we look forward 10 years, historically, the annualized returns have been between -2% and 2% a year. So yeah, we can go through a period of significant sideways markets, and it depends where you're at in your investment life cycle on how much that could hurt you. And if you've listened to the show, we talk a lot about Microsoft. And if you had bought Microsoft in 2000, it took you 14 years to get back to even. 14 years. Now, we're cherry picking that start date, of course, because if you start it a year or 2 or 3 later, the story can be totally different, right? But you look at the valuations in the early 2000s, there is some correlation, in my opinion, to where we're at today. And so, yeah, I mean, it could be, where we have very meaningless growth, over the foreseeable future. And that's where, obviously the banknotes come in. And when we can get, double-digit cash flow, on a annual basis, paid monthly with 30% downside protection before you don't get paid that monthly coupon. And it's backed by, obviously, the largest banks in the world. That's something we should talk about and have a conversation about and debate and really see if it makes some sense. And then, obviously, Bison 2. Bison 2 is the energy strategy. I want to talk so much more on that. That is such an educational story. And we have a educational series that we're about to launch. So 630-492-1912 if you want to learn more about that, 630-492-1912. But energy prices, when you look at the underinvestment that we've had for any length recently, let's just call it what it is, we believe, as well as many, many people who are incredibly smart, believe that oil prices are going to be significantly higher in 3 to 5 years. And it is a great time to be acquiring assets in the number one oil field alongside as an owner of the wells of the Conocos, Exxon, Chevrons, Matadors, Vaqueros of the world, the majors, mid-majors. And not only do we target is a target, doesn't mean you're going to hit it, but we target a 15% cash flow annualized. So we like to pay, distributions, of course, but the tax benefits are significant. Tax benefits are anywhere from targeted $80,000 to $90,000 per $100,000 invested. So that can reduce your taxable income, active, passive, W-2, 1099, by that much. So again, we're not tax professionals. Best practice, always talk to a tax professional, whoever you get your tax advice from. We certainly can get on that call with you. Very black and white, but again, we just have to give you that caveat because we can't provide that tax advice. But the tax benefits are significant. And when you look at the valuations in the market, and if you look at the sideways, markets that we may have, you have to have cash flowing assets, in my opinion. The bank notes, Bison 2, Bison Alpha, which is our hedge fund strategy that is event driven. That is really, we look for strategies in the market that there's some sort of a catalyst that of either upward movement or movement going down. With the use of AI, it really allows our PM to really check his thesis and make sure that it is what he thinks it is, and really just trying to cover all of our blind spots. So ran over a little bit, but more after the break. 630-492-1912, 630-492-1912. There you go. Talk to you when we get back.
Are you close to or already in retirement, and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 850-495-3033, or find out more at KuhnCP.com. That's KUHNCP.com.
All right, last segment. Welcome back. You're listening to Destination Retirement. Had a couple senior moments towards the end of last segment. Hey, it happens to the best of us, right? And I always try to tell the individuals that produce the show, just let it be natural. Just if I sound like an idiot, let me sound like an idiot. If I say too much, let me say too much. All right. We want it authentic. We want to just educate, and that's what we're here to do, because far too many advisors don't do that. Far too many advisors simply have what we call closet index funds that are marketed as something very proprietary, strategies that seem really attractive, but yet just track the markets up, track the markets down. Really good strategies in up markets, but then you realize when the markets go down that there was very little value being brought to the table, at least is my belief. And if that's how you want your money managed, please stop paying an advisor. Don't pay us. Don't pay another advisor. Go to Fidelity, go to Schwab, go to Vanguard, and set it and forget it. That wouldn't be my recommendation, but again, this is your money, and you're able to do with your money as you see fit. And so I just would not include or have that fee drag if you don't have an advisor that is being very proactive, an advisor that is bringing strategies. Again, as you know, we kind of categorize our investment philosophy and thesis in 4 ways. We have our protected growth, we have our growth, we have our opportunistic growth, and then we have our tax reduction strategies. And we look at protected growth. We say protected because both of those strategies have some sort of a downside protection built in. So when you look at, again, the 5-year annuity, your worst year is 0. So, the only annuity, I guess there's always outliers, so I hesitate to say the only strategy we're going to use, because we definitely have some outliers for some very strategic reasons. But generally speaking, we will only use a very short-term 5-year annuity that is tied to the S&P. So none of these goofy indexes that look great on paper, but in the real world have never really delivered anywhere close to what the back-tested data shows. So we will just use the S&P, and currently the way that these work is they work on a year-over-year basis. So the day you do it, 1 year from that day, they will look at the S&P, and if the S&P is down, it doesn't matter if it's down 0.5% or 50%, your return is 0. So you can't lose money. Now, when I say that, it's not FDIC insured. It's not backed by the government. It's backed by the insurance companies. But again, just like the bank notes, we believe that these are the most very, very strong insurance companies, right? So your worst year is 0, and it is tied to the S&P. And currently, now it can change. I want you to understand that. But currently, it is getting 10.5% of whatever the S&P does on the upside. Now, it doesn't include dividends, all right? So it's just 10.5% of the price movement. So from 0 to 10.5% of the S&P, you get 100% of that return. Anything above 10.5% you don't get, so you're capped at 10.5%. Again, this is what we call our protected growth bucket, right? Why do we say it's protected? Well, again, you have the downside protection, and then you got the cap on the upside. But when you get that gain's locked in. So in year 2, if the markets go down again, you don't give back the previous gains, and it's only a 5-year investment. And so for those individuals that want to offset equity risk, those individuals that are close to retirement, that they don't want to tie their money up in the mess of the bond market, at least it's a mess as we see it, that can be a very viable strategy for you. And then on the other hand, for our protected growth bucket, we use the bank notes. Again, those are very simple. Most of you can probably articulate them as well as I can if you listen to the show for any length of time. We talk about great amounts. We talk about the bank notes, but those are offered by the biggest banks. So Citi, JP, Morgan Stanley, UBS, BMO, BNP, Bank of Canada. I mean, there's just many of them. And we say protected because you're getting your coupon payment as long as those indexes don't go down 30%. So as long as those indexes from issue are not down 30% on the valuation, the monthly valuation date, you still get paid. So it could be down 29.99, and you're still going to actually get that cash flow. And so very, very strong story to be able to look at that. And so when you look at the protected growth bucket, that's a really good bucket. And some people want a ton of that bucket. Some people don't want a lot of that bucket. Again, through the financial planning process, through the tax mitigation process, through cash flowing and running a cash flow analysis on RMDs and what that's going to look like. Again, if you have a 7-figure IRA, you are going to be shocked what those RMDs are going to be with current tax laws. And we can show you that, and we can offset that in many ways with the energy fund, where we can do Roth conversions if we have capital outside of a qualified state, so just taxable money that we can combine that. You do 100,000 or 200,000 or $500,000 or $1 million in Bison 2, you convert $1 million. Maybe you're only paying taxes on $100,000 where, or $150,000 when you did $1 million conversion. I mean, it really becomes a math equation But those are the things that we want to really bring to the table. So that's our protected growth bucket. I did talk a little bit about our tax reduction bucket, and I guess I'll just go there because it's kind of on. When you look at kind of a barbell, it's protected growth, and it's the energy strategy on the other side. That cash flows as well. Currently, we are cash flowing, just finishing up and looking to close the second fund. So we probably hope to have that closed in June, July, and then Fund 3 launched. Same strategy, same philosophy, but we do it try to do it in yearly funds. It's kind of looking more like 16 to 18 months funds recently, but we would love to get it down to annual funds. But again, you just have those two strategies, and then just the S&P or an asset allocated model. You are so much further ahead than not having those strategies. And 630-492-1912, 630-492-1912, and let us educate you on the good and the bad and kind of all of the risks and rewards of those models. And then the other two sleeves, buckets, call them what you want, our growth bucket, third party, institutional manager out of Chicago, which is neither here nor there. But quantitative manager, they were kind of quantitative managers before quantitative management was cool. They started as a research shop for Wall Street. I think they're 16, 17 billion now, 15 billion, something like that, but meaningful. Great rankings versus their peers, significant outperformance versus the S&P. If you go back to 1995, I mean, meaningful outperformance in the models that we use, which are the focused growth model and the all cap model. Again, past performance. It's not indicative of future results. I have put a little bit more stock in this performance, though, because it's mathematical and it's quantitative and it's not gut feel, but we just want to be transparent, obviously. But significant outperformance, to the tune of, 1.5 to 1.75% a year. Doesn't sound like a lot, does it? Sounds like nothing, really, right? You do that for 30 years, goodness, that's, 1,000% cumulative outperformance of the index if you just bought and held during that whole period. So again, something to look at. Really, again, different philosophy. They believe in it's just such an amazing model. I don't want to dive into that rabbit hole right now, but a quant manager, and then you have Bison Alpha, our hedge fund. And again, it's a strategy that we can hedge. It's a strategy that we can use options. We can go long. We can go short. It's an event-driven inflection type of a strategy. Really, it's kind of our philosophy of how we would manage our personal assets. And, so we created a fund with that philosophy so we could do it at scale. So hopefully we get, that fund. We did just launch fourth quarter of last year. Hopefully by the end of the year, it would be great if we could see that fund at, 50, 75, 100 million. We think there's capacity for probably 300 million. So we obviously have a ways to go. But again, it is something that I think when you look at the four strategies, the four philosophies of protected growth plus, or opportunistic growth, and then tax reduction, I think you're going to be hard pressed to find anybody in the Midwest and really throughout the country, in our opinion, that is going to bring you those unique of strategies. And we're glad we do it. We've realized that we need to be much more educational, not that we're salesy, but we have to have more education out there for people to digest it, because it is relatively simple, but we think it's so great to be able to, have that education, watch some 3 to 5 minute videos, 7-minute videos, a series of videos at home, watch it a couple times, listen to it in the car. Because again, we really at the heart of all we do is education, and we think our strategy is better than most. And we truly believe that if the markets are down to sideways, we're going to deliver better than other advisors. And we think even in up markets as well, we're going to deliver better than other advisors. That's our opinion. That's why we do what we do. So 630-492-1912. I hope I get to meet you this week, next week, or the following. Give us a call, 630-492-1912. Make it a great week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.